Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for our roundtable segment, we have Phil Mackintosh, Chief Economist at Nasdaq, as well as Chris Dearborn, Max Cabasso, and Brian Joyce joining us remotely from Nasdaq's Market Intelligence Desk. And we also have Fausto Pugliese, President of Cyber Trading University. We're going to take a look at the big picture trends in 2023, and we'll also look at some expectations going into 2024. And Phil, I'd like to kick it off with you. I feel like 2023 delivered a little bit better than perhaps people expected.
Yeah, way better if you look at the equity market performance, and especially if you look at the Nasdaq 100. It's up over 40% already year to date. It's because of relatively small selection of the tech stocks that caught up in the AI rally, the Magnificent Seven they call them. If you look at the performance of something like the Dow, it hasn't gone up nearly as much. If you look at the performance of European equities, they haven't gone up as much. But I think if we sat here a year ago and talked about whether equities would go up at all, with rates going up, getting to all-time highs, the economy slowing down, the fear that the consumer would run out of cash, we would never have thought that we'd have had such strong earnings growth into the end of this year and a market that's gone up 45% on the Nasdaq 100.
And that's a great point that you make. And Chris, I'm going to kick this over to you because your specialty on the desk, of course, is covering consumer and retail. And you and I have spoken about this. You cannot bet against this consumer.
You know what? The consumer is a big driver, both the economy and for the stock market, really. It's 2/3 GDP on all different levels, as but really the main part of this is the disinflation narrative. That's really what sparked this off. The employment report for September and October was really the kickoff to where it saw that softening that the market wanted to see. It saw that the consumer was still spending. Wages were growing, albeit a little bit less, but still increasing. So you have a lot of ideas there that kind of are making the Fed think that we really will get that soft, or as the new name is, no landing into the marketplace. And that's going to be good for stocks. That's good for risk on. That's going to be good for speculative items. And with the 2 and the 10s kind of rolling over a little bit, you know what? It's got legs. November was a great month, up almost 9% across, 8 to 9% across the board. December is kind of following through. Consumer tech, consumer discretionary tech are 2 of the strongest sectors out there right now, and you're coming into the holiday season, and numbers are pretty good there as well. Not great, but still growing year over year. So when you look at that, the question is, will the consumer in a softening labor environment continue to be able to spend and carry the debt? And that's what the concern is moving into next year. People will spend into Christmas, but will people continue to spend into next year? And that's the concern that we have.
Right, and of course, before we get into next year, I mean, Fausto, we have a number of macro events on the calendar. We have, the all-important NFP on Friday. We have the FOMC meeting, CPI data coming out
unemployment
next
data.
Week. I mean, I'm sure this is going to be one of the most key reports we heard out of the FOMC this year, because there is speculation that they're going to, either hold rates where they are, dial them back a bit. I'm sure what comes out of the meeting is going to be widely picked apart.
Well, that's funny you said it, because like when we were here last time, we would talk about the earnings, and they said, listen, 80% of the companies beat earnings. So what ends up happening, what's happening now that everyone's probably going to be seeing is that now you got to worry about these bank stocks have done incredible too. Mike, I don't know if you noticed that, but even we're talking about having a good month or whatever. Bank stocks are up almost like 20%, maybe 15% past, about 20% the past month. So those I'm going to be focusing on as traders. I see orders keep bidding, people keep bidding them up over and over again. But December is always kind of a slow month though. December every year is like, like you say, going to the holiday season, Christmas time, people want to spend their money, people want to close out their positions, finish out their tax season. So I'm not going to be super, bullish or even bearish on a December. We'll see what happens going December. But with the rally we were talking about it earlier, I think a lot of companies are looking forward to that. Maybe they're going to cut rates. The rates have stopped, they didn't raise them. And I think that's what many companies are looking at, and that's probably why the banks are also doing pretty well too.
Yeah, and of course, Max, we know that AI, as an example, was a key theme in 2023, and I think we're getting to the point in 2024 where the news cycle is really going to be focused on, okay, how do we quantify? Is there product out there? Are there revenue streams? Are there recurring revenue streams? It's almost like we were talking about this with another panel today, ESG greenwashing, AI whitewashing. How do you quantify these measures? What does that mean for earnings?
Yeah, it's funny. I actually had a conversation with a company last week about it, how it was the kind of the hype cycle this year, and everything's kind of moving even quicker than I had anticipated, where investors are now focusing on, okay, we hear the story, now show it to me. Now show me how you're actually going to monetize this. Now everybody knows the big ones, the chips, NVIDIA's, and the Magnificent Seven, how they're going to do it. But everybody, they see how many times it's mentioned in press releases and earnings, how everybody's saying AI. Now it's time to actually show where you're getting, because you've seen multiples expand. Software in particular has really started to outperform again into the end of the year. I think software is actually outperforming even the NDX. So it's really had a gangbusters year. And again, multiples have continued to expand there after contracting earlier. So again, you're starting to get the premium in some of those names again. And if it doesn't start to show up in earnings, I think there could be extra pressure on them.
Yeah, well, I also think it's interesting too. We're finally getting small cap participation. We haven't said that like actual participation in what, 3 years at this
I mean,
point.
the Russell's up almost 12% from the October lows. That's a big move, but it's at almost 7% year to date, which was kind of unexpected. Remember, small cap is a risk-on type of mentality, and if you see investments flowing into the small cap, especially in the Russell 2000 names and the Russell microcap names, that's telling you that people are putting cash to work, and where they're taking that money out of, they're taking it out of the bond market.
Yeah. Well, I mean, especially too, Phil, with small caps, they're really exposed to cost of capital as well. They don't have, the big balance sheets like you might see in the Magnificent Seven and so forth. So, if there's this expectations that rates might dial back a bit, that helps their margins if cost of capital is lower.
Yeah, I mean, everyone's been talking about the refinancing wall for debt on the company balance sheets. And if you look at, it's not really a wall. I mean, if you're a large cap company, about 10% of the debt every year for about the next 10 years kind of has to come up for refinancing. So you've got a pretty long runway for rates to come back down from the highs they're at now. But if you're a small cap company, the next 2 years aren't too bad, but then there's actually a hump where there's 20%, 20%, 20%. And so that's obviously a concern. If rates stay high for that long, then the refinancing is going to kick up their interest costs and it's going to impact the margins a lot.
All right.
What do you think on interest rates? What would be the right nominal rate for us to be at to make sure that the markets kind of continue to flow through here? Is it 3.5?
I mean, we're not going back to zero. I don't think that's
not real.
Unless we have a recession, which we all hope we don't have. I think if you look at, growth meant to be really weak next year. If you look at the PMIs on services are softening, manufacturing's in recession. So we think growth's going to be pretty weak. Inflation's already down to 3-ish, so it could easily get down to 2. I mean, how much extra do you need to tack on to a 10-year rate to make the actual real rate the right rate these days in an aging economy with a sort of shrinking workforce, especially in Europe? Maybe not that much. So I could see rates coming down to sort of 2.5, 3, and not being crazy.
Well, I mean, even for the housing market too, to get that moving again, where you don't have that stagnation in inventory. And I will tell you, because I am a Zillow freak and I love looking at the listings, certainly over the past 2 to 3 weeks, as the market is thinking about or pricing in at least rates not rising anymore, or the expectation they might start to come in the second half of 2024, you're starting to see more listings come online, which I feel like some of those anecdotal measures, it's almost like, what are your kids talking about? What are the hot items, for Christmas? Follow the money, and what stocks, correlate to that. I feel like with even the inkling that rates might come back in, what is it, 5-6% that gets a housing market moving?
I mean, supply, well, it comes down to supply. The supply is dead right now.
Right.
So if mortgage rates were over 8% not even 30 days ago. They've come in a little bit, but still that's a lot of money to put into and refinance. Do you wait and hope for a 4.5% mortgage, or do you go out and buy now because you're still fearful of the supply constraint that you're seeing in the
But even 4.5%, 5%, I mean, that's a big move when you think about how quickly we went up to get back down there. I mean, you want to be careful about how quick the rate reversal is as well. At this point, however, I want to bring Brian Joyce in. He is our Managing Director on Nasdaq's Market Intelligence Desk, as well as our resident technical analyst. Brian, it's great to see you as always. Welcome back to Trade Talks. And we're talking about things from a fundamental perspective here, but I want you to take a look at a couple of charts for us, kicking off at the S&P 500. What is pricing? What is it confirming in terms of action?
Thank you, Jill. So here looking at the S&P 500, we're looking at the weekly period chart. We can see we had 5 straight weeks of just straight upward performance beginning in that first week of November. So we had a very strong move, but really we're back again to where we were at the highs in July, which is around 45.95 to 46.40. So we hit the lower bound of that range there, which was tops going back to February and March of 2022 and this past summer. And so this is definitely a key resistance level that the S&P 500 has been telling us, because it's been topping out here now on 3 or 4 occasions in the past. So it's an important technical level, and I think it really has a lot to prove here. This week's price pattern so far, we're only midweek, but good potential here. See some signs of stalling out. We've had certainly a very strong move off the lows. One thing I do like is that the advanced decline line on this next screen here, that's in my lower panel, the advanced decline line did make a marginal new high when I look at the number of stocks making new 6 months and 12-month highs, that hasn't yet made, let's say, a higher high versus what we saw even earlier this year in 2023. So some breadth measures are looking, constructive. Others have yet to say confirm, this strong move to the upside. We do want to see that breakout though above around 4,600, 4,640 to see whether or not we can then move on to the highs from 2021, 48.19, late 21, early 22.
Right, Brian, and of course, if we take a look at another big picture trend for 2023, we saw gold recently hitting a high. What are the charts telling you in terms, longer term perspective there?
So longer term perspective, we could see, gold is still really in this long-term sideways range. It topped out in 2011 after a 10-year uptrend and peaked around the 1921 level. It has in the last 3 years been in this sideways range after returning to that 2011 high. So we're now in a 3-year sideways range between roughly 1,700 and almost 2,100. Let's call it 2,075. So, this week you could see it has a pretty toppy looking candlestick pattern. Other metrics that I would want to see performing better or looking differently in order to be more constructive on gold in the near term is the ratio of silver to gold. And as you can see here, silver's in the numerator, and it's really just in this sideways chop here. There isn't any sort of really upside breakout or confirmation. Typically when gold is in a longer lasting uptrend, silver is actually outperforming gold as well. Both metals doing well on an absolute basis, but silver outperforming, and we're just not seeing that here in this ratio chart. And then gold to stocks, gold to the Dow Jones Industrials. This is a longer term monthly period chart, but you can see this tends to be one asset class outperforms the other for, in the last 10 years, stocks have been outperforming gold. The prior 10 years, gold had outperformed stocks. Before that, it was 20 years where stocks outperformed gold. So right now we're kind of in this sideways chop. The last 4 or 5 years or so, they've been near equal performance between the two. So nothing yet on that front on the ratio analysis is telling me that gold is ready to make a longer lasting move here. And this is just an absolute chart of silver, and you can see really just 3 or 4 years of just sideways choppy price action for silver here. So when going back to gold here, it does look like it's on the top of its 3-year range, which really kind of goes back to 2011. So it's been a long time up here around these levels, but I'm just not sure yet if an upside breakout and a strong near-term move is in the cards right now.
All right, and finally, Brian, a technical read on the tech sectors. We know that that's been a key driver in at least propping up the Nasdaq 100 this year.
Yeah, absolutely. So Nasdaq, the S&P 500 tech sector, this is the large cap technology right here. And this to me, is very optimistic right here. What I'm seeing is a cup and handle pattern, and the range of this consolidation is about at least 1,000 points, if not 1,100 points. And so we did kind of break out above the neckline of this setup in the last month or so, and we just want to see that upside acceleration continue to go. So, if this pattern proves true to its technical projection based on, the prior consolidation range, I could see this index easily going up another 20-25%, over the longer intermediate to longer term.
All right, Brian, appreciate the technical insight as always. We'll chat with you next week. Thanks for joining us on Trade Talks. And finally, guys, to wrap up here, let's just get a quick 30-second look from each of you. Phil, starting with you, key themes you're going to be looking for going into 2024, or how, investors should potentially be thinking about the market.
I think unemployment's going to be really worth looking at, because if we get a little bit of a spike in unemployment, we're probably going to have a weaker consumer, and then I think we have a totally different outlook in terms of earnings growth.
Yeah.
It's definitely the disinflation narrative. That's going to be the entire key driver here, and whether the consumer continue to power the market through or not. The top stocks are going to do what they do, and it's going to power the large cap names, but the rest of the market needs to follow through, and without a strong consumer, it's going to be a problem.
Yeah, I'm going to focus a lot more on what's going to happen with the SEC if they're going to approve this new Bitcoin ETF, and what's going to happen. I think that's the 10th is, I think, the cutoff date is 24th. If that happened, you saw a lot of the stocks, like a lot of the big Coinbase did really, really well. You see a lot of the Mara and Riot. Somebody could focus on that and see what happens, because Bitcoin's been doing really well, and obviously we trade more of the stock equity part of it. So I really want to see what's going to happen with that. I know a lot of people are banking on it.
Yeah, and you and I talk about Bitcoin all the time.
All the time. Yeah, I'm looking at, does growth buckle or does it break? Is it, a little gyration, or is it something really structural that's a problem? Have companies learned from, the hiring trouble they had during COVID, where they couldn't find work? Are they going to be slower to lay people off and kind of hold on to them a bit longer, where we don't see that real jump in unemployment where a consumer can hold on. You know, and also what does the Fed do, not just with rates and cutting, because again, like we said, not going to zero, but with quantitative tightening, you know, are they going to ease up that, or are they going to continue to, you know, cut down on the balance sheet? You know, is the liquidity there for them to do that? You know, if it's not, you know, they might slow down. That's going to be, you know, constructive for the market.
All right, appreciate the insight as always, gentlemen. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.